Okay, so let's continue on the share capital or shareholders stock, right? So the stock or the capital stock is later we look into when you look into the presentation of the balance sheet item under honest equity. So we'll see that stock is divided into the presentation, all right, of the stock is actually we have the one is what we call authorized share capital, number one. Yeah. Authorized share capital means that these are the maximum number of shares of capital that can be sold to the public. So these are the maximum number. So we got authorized share capital. From the authorized share capital, you see that there are two. All right. For example, authorized share capital is 1 million, right? 1 million. So maybe 700 has been issued and 300 has not been issued, right? Example. So here 700 is the issued shares that have been sold by the company, all right? And unissued shares are still the remaining stock that have not been sold. So we have the issued and unissued shares based on the authorized of 1 million. And then from the authorized, all right, the issued share just now, all right, we have what we call outstanding shares are shares issued that are owned by the stakeholder. So, but then we also have what we call treasury shares, right? So treasury shares here is the shares that have been acquired by the company. So what happened is that, let me show you that. All right, first, for example, when you sell your shares to the public, you're going to receive cash from the public and then credit your capital, right? But later, after some time, maybe a few years, you want to acquire back the share that you purchased from the public. So this is what we call buyback, shares buyback. Yeah, shares buyback. So when you have shares buyback, it means that you have to purchase back the shares from the shareholder. So in this case, you're going to debit and credit. You have to pay to the shareholder for you to buy from them. So that's why you have to credit. But what you buy from them, we're going to call that as a treasury shares, right? Treasury shares. Sana age. All right, treasury shares, or that's what we call here. Treasury shares are issued shares that have been reacquired by the corporation. All right, there could be several reasons why the company wants to buy back. Among others, could be to control, all right, to have control over the shareholders. And then, of course, when we talk about stockholders, so when you issue shares, normally we should know what is the par value. Par value is an arbitrary amount assigned to each share of stock when it is authorized. So when you authorize first, when you want to authorize your shares, you should know what is your par value. Right, but the market price is the amount that each share of stock will sell for in the market. So the par value is always remain the same as authorized. But when you sell the shares, it depends on the value of the shares. The value of the shares will also depends on several factors. For example, if the company is a very profitable company, then of course the shares is higher. The share price is higher because everybody wants to buy the share. So again, it goes back to the market demand and supply. Right. Similarly, if the company have a very good credibility, the company maybe the performance of the company is very good, they have a very good credit limit, for example, so people are willing, the earning per share is also high, so people wants to invest in the company, all right, because you may get a better dividend returns, all right, on your investment. So when you offer the price or the shares to the public, then you are offered at a market price, right? So either your common stock can be issued in three form, a par value, right? Par value, and then we also has all proceed credit to common stock treated like par value. Okay, let's go into this issuance of par value stock. It means that when you receive, right, debit your cash, and then in this case the number of shares times by par value, the remainder is assigned to the additional paid up capital. So it means that, for example, here, yeah, you issue 10,000 shares, 10,000 shares, par value $2 only. However, the stock price is 8 ringgit per share. So how much actually you get? All right, you have to record one is a par value and the balance is the 6 ringgit. So your share price is 8. Share price is 8 ringgit, but the par value is 2. So the 6 is what we call the additional paid in capital. Or sometimes we call it share premium. Right? In Malaysia, normally we call it as a share premium. Okay. Right. Then, so how to record that? You're going to debit your cash because this amount of cash that you actually receive, 10,000 cents per 8 per share. But how to record the common stock is always at the par value, and the additional period, or you call it as a share capital, share premium, or share premium. All right, you're going to credit because this is a revenue in nature, yeah. So you are going to have the two different types of account. When one is the common stock at the par value and the share premium, the difference between the par value and the share price. Okay. And then I also want to introduce to you, all right, just a short one, a preferred stock. So what is a preferred stock? A common stock is the two types, all right. The common stock, for example, here, this is what you will see in your financial statement, all right, your balance sheet item under owner's equity. If you look at here, all right, the common stock is the one that we have discussed earlier, is $5 par value. Authorized is 3,000 shares. Issued and outstanding is 2,000 shares. Right? So how do you get the 10,000? 10,000 actually derived by the par value $5 times by 2 million shares. You get 10,000. But you also have what we call the second category of shares, what we call preferred stock. All right. So you see that the preferred stock, they have a 9% cumulative. Par value is $100. Authorized is only 100,000 shares. Issued and outstanding is 50,000 shares. So in this case, again, the par value is 100. So how you compute the value of the preferred stock is 50,000 shares times by $100, which is the par value. Okay. So, and then we have additional paid. This one is because the different, this is the share premium, because the share is offered at a higher price. All right. It's not stated here, but it says that in total, the preferred stock is you have premium of 500,000, and the common stock you have a premium of 20 million. So that's a lot, yeah. So total paid in capital is 35,000, which is the total of all these preferred plus common plus your share premium. All right. Then retained earning is actually from your profit. All right, the retained profit plus your profit for the year minus dividend is 17.5. So total stockholder equity is 53 million. So remember that again, it comes back to the principle of asset equals to liability and honest equity. So in this case, your honest equity here is 53 million. So you have to look at what is your liability and what is your asset. All right. So what is a preferred stock? It's a separate class of stock. All right. Normally having a priority, all right, over common shares in terms of the dividend distribution. Normally the rate is, for example, just now I mentioned that 9% cumulative. So that 9% is the dividend rate. Yeah. And they have the priority in terms of the distribution of asset in case of liquidation. They also have priority in terms of the distribution of dividend, right, prior to the common stakeholder, right? Sometimes we do have the cumulative dividend rights, all right, and normally callable by the company and has no voting power. So that's the difference between common stock and preferred stock. They have no voting power, and then they have a dividend which is sometimes cumulative, sometimes it's not. So what is my cumulative preferred stock? It means that dividend in arrears must be paid before dividend may be paid. to the common stock. So it means that, all right, if it's 9%, you have to pay 9%. If you only pay me 5%, the 4% remaining, right, you have to pay me first in the future before you can pay to your common stock. So that's why it's called preferred stock. Yeah, preferred shares, because they are given the preference treatment as compared to common stock. But we also have the non-cumulative, right? Means that if the company did not pay, then there's no response, there's no obligation for the company to pay in the future. It's not accumulated. Yeah. Okay, I think that I will not, okay, in terms of the sources of corporate equity, all right, we classified based on preferred stock, common stock, and your retained earnings. So we have the three, just like we had the presentation here. We have the preferred stock, common stock, and then additional paid in capital. Then you have your retained earnings. So that is the sources of your honest equity. Okay. I will not go very detailed on this. Market price of common stock, all right, among the factors that will influence the market price of common stock is the investors' expectation of future profitability, as well as the risk that this level of profitability will not be achieved. So it will give an impact on the value of the share price. Okay, we have the stock split. So this is just for your information. All right, for example, company used to stock splits to reduce market price. All right, outstanding shares increase, but the par value decreases. So for example, that a company has 1 million shares of 10 ringgit per value. But if you split, you're going to split 2 into 1. So it means that before you have 100,000, now you split the shares 2 to 1. So for every one shares, now you get 2. So after split, initially we have 1 million shares. Now after split, you have 2 million shares. But the par value initially it was 10. Now it reduced to $5. Why? Because 2 to 1. Yeah. But the total value of the shares remain the same. It's just that the number of shares increases, but the value of the shares decreases. Yeah. So that's the reason why company also want to have, because they want to give, for example, give more dividend to the shareholders based on the number of stock. So after split, normally they will pay out dividend. So a shareholder will get more dividend based on the number of shares. So these are the treasury stock that we mentioned earlier when the company buy back their shares from the shareholders. So, but this treasury stock has no voting or dividend rights, all right, that has been acquired by the corporation. Okay, so you see that when you acquire treasury stock, you have to pay. So that's why your cash is credited. So you debit into your treasury stock. Okay, I think that stockholder presentation, again, in your financial statement, balance sheet item, you'll see this kind of presentation for your stock shareholders or honest equity. You see that the treasury stock is given as a deduction, yeah? Given as a deduction in arriving to your total stock equity. So careful with that, because remember your treasury stock is a debit entry. So when it's a debit, everything else is a credit. So that's why you have to minus. Yeah, so because your closing will also be a credit figure. So your treasury stock is deducted. All right. So these are some of the ratio that again we look into when we do the ratio analysis, financial analysis, return on asset and return on common stockholders equity. Okay, so I think that's all for the stockholder chapter 11. More importantly, you at your level you should know what are the different types of shareholders equity. All right, common stock, preference stock, you have your treasury stock, and then we also have introduced the split stock. Yeah, so all these things are the types of shares, and you should know how to record that right upon issuing to the shareholders. You can also have the treasury stock when you buy back from the shareholders, and then you split the stock. So all these are the common terms that you should know under this chapter 11. I think that's all for today. Thank you. Assalamualaikum warahmatullahi wabarakatuh.